If you're ever planning to buy a home, you need to see this. Now that you have decided to buy a home, you need to know how much you can afford. You also need to be aware of the additional cost associated with purchasing and maintaining a property. There are a number of factors such as your income, credit score, down payment, debt, etc. that can affect what you can spend and how large of a mortgage you can afford to take on. The videos in this series will help you determine how these factors affect the size of your mortgage and what you will be able to afford. Welcome to the next episode of Breaking Down Real Estate. When shopping for a home, it's important to determine the maximum mortgage and home price you can qualify for. Mortgage affordability is simply the maximum amount you can borrow. To determine your maximum affordability, lenders take several factors into account. The two primary factors that they consider are your down payment and your debt service ratios, which is based on your income and current debt obligations. Because Canada has a minimum down payment rule in place, the amount of money you have saved for down payment can affect your maximum mortgage affordability. If it's your primary residence, the minimum down payments required to buy a home in Canada are as follows. 5% of the purchase price for homes priced up to $500,000. A combination of 5% for the first $500,000 and 10% on the balance amount for homes priced up to $1 million. And 20% of the purchase price for homes valued over $1 million. In order to assess the maximum mortgage a lender can offer, they do two types of debt service ratio calculation. Gross debt service ratio or GDS and total debt service ratio or the TDS. This maximum mortgage is then combined with your available down payment to determine the maximum home price you can purchase. Your lenders uses these ratios to ensure you can consistently make your monthly payment, as they place a limit on the amount of your income that can go towards your housing expenses and monthly debt obligations. The GDS considers mortgage payments, property tax, heating costs, condo fees, etc. And the maximum GDS limit used by most of the lenders to qualify borrowers is 39%. TDS, on the other hand, considers all these housing expenses as well as credit card interest, car payments, loan expenses, etc. and the maximum TDS limit is 44%. If the mortgage you want to take on forces your GDS or TDS above these max rates, most likely you will not be approved for that mortgage. But that's not the end of the world. Let's see how we can increase your maximum affordability. Number 1, increase your down payment. This will give you the ability to increase your affordability and purchase a more expensive home. Many Canadians do this with family assistance and from other investments. Number 2, pay off your debts. This will lower your TDS ratio and free up more of your income for your mortgage payment. Number 3, increase your income. When I say this, the first thing that comes to your mind is a job change. But keep in mind, changing jobs during the home buying process can be risky. There are other ways to increase your income. You can apply for your mortgage with your partner, or get a co-signer such as your parents or siblings to get into your mortgage. And now for the bonus step. For some time now, the industry experts have been suggesting that the traditional TDS formulas be amended to include a 10% savings buffer. This concept has gained traction and even earned the nickname the Total Debt Service and Savings Ratio, or the TDSS. When deciding what your maximum purchase price is going to be, it's important to make sure that you have enough room left over in your budget to pay down your debt, save for the future, or whether if the interest rate changes or there is a job loss. Thank you so much for watching the part 1 of a series of videos. Stay tuned. See you soon with the next video.